Jordan Waxman, before we look ahead to 2016, I want to review a few lessons learned from 2015.
Sure.
And the first one is the trend is your friend, especially when it comes to FANG stocks, right?
10 stocks out of the S&P 500 this year are up about 14% on average through a couple of days ago. The other 490 are down an average of 5%. So it's been a very narrow market. That's happened. It happens once every sort of 7 years. Active management probably does you well going forward. But lessons learned here, yes, very narrow breadth. If you weren't in those top performing stocks, you know, the FANG stocks, Facebook, Amazon, Netflix, Google, you didn't do so well.
And also the dollar stayed strong. Some people thought it was going to get stronger, maybe parity with the euro, but it stayed strong.
Well, the year-end forecasts for parity with the euro may have to be pushed out a little bit. I think you have a little short-term blip rally, maybe a short covering rally in the euro. But yeah, that trend has been your friend, and anything that's pegged to the dollar, whether that's commodities getting cheaper, gold, silver, oil, that's continued, and into next year it probably will continue as well.
And that's another trend. So you do expect commodities to stay weak in 2016? What's your forecast there?
I think the currency trend will continue, but if you just look at the equilibrium price of oil, for example, there's oversupply this year. Chances are a fair amount of supply is going to come off the market. Next year, demand's going to tick up. I don't think investors believe it. I think investors believe there's going to be a hard landing somewhere in the world, and central banks, 9 out of the top 10 central banks are easing conditions by buying back bonds and keeping interest rates low. So I don't think the world believes that there's going to be this equilibrium. But if you just look at the demand and supply forecasts, that should come back into equilibrium, which means a higher oil price going forward.
All right, so that's a little bit of a look back about the trends of 2015. So are there any other trends that you're seeing as we head into 2016?
Well, you know, you had huge stock buybacks in the last few years that have helped earnings of S&P companies, really all companies in the United States. $560 billion this year. I think the all-time high is maybe $580. Maybe you get another $600 billion. It's a little bit more expensive to finance the companies to finance themselves. But there doesn't seem to be that much global demand for things. So in absence of that, you're going to have stock buybacks, decent dividends, low stock returns going forward.
All right, and final question, when do you step in and go against the trend? So when do you want to become a contrarian in the current environment?
There are some things that have gotten hammered in the current environment, well beyond where they should be trading. The intrinsic values are, and I think you've seen a snapback in the Master Limited Partnership Group over the last 2 days of about 12%. Just the companies came out and said, we're reiterating our guidance. Every now and then you'll get a company that has to cut their dividend to retain cash, but the underlevered companies will still be able to pay and grow their distributions well into 2017, 18, 19. I think you need to be a contrarian to buy the things that have really gotten hammered.
All right, well, thanks a lot, Jordan.
Thank you. Good to see you, Greg. Thanks.
Thank you for watching The Street.